Welcome to the Good Money Podcast. My name is Josh Walker. I'm one of the owners of Reed Investing. Today, we're going to talk about taxes. If I was really cheesy, I'd call it talking about taxes, like talk about practice. Shout out to Allen Iverson, but I'm not that cheesy. So, talking about the specifics of taxes, think about this as the defensive part of your building wealth game. Building wealth is just a huge game. You need a game plan. You need a playbook to study. You need to learn your options. It's all about stacking days, right? Learn a little bitty thing today and learn a little bitty thing tomorrow. And maybe there's something else you want to focus on next week, but you need to stack days to become familiar with these things. I'm a huge fan of Kobe Bryant. Say what you want about Kobe. I loved him to death. Kobe didn't work on everything all the time. And a lot of times as investors, we have so many things available to us that we get lost in the weeds of what we should be focusing on. One of the things I loved about Kobe is that he would spend hours perfecting a single move. He would spend hours or days or an entire summer perfecting one specific part of his defense, and he would do that every single summer. So it stacked year after year. He was stacking days on days on days, and that's what we're going to do. So we talk about taxes a lot, and most people do not like to talk about taxes. Taxes are like leg day. Taxes are most people's largest expense, and for that reason alone, you should not skip leg day. If you want to build wealth, you have to play offense and you have to play defense. Offense is creating additional streams of income. Defense is mitigating or eliminating your expenses, and your biggest expense is taxes. So don't skip leg day. You are playing from behind. If you just ignore it and you just say, okay, taxes are what they are, it's too much to learn, it's too big a mountain to climb, I'm just going to pay my taxes and try to make more money. You will never get to the summit that you could reach if you don't learn these things. And it's not as complicated as you might think that it is. If you just learn a few little things, you can go miles and miles down the road of potentially just completely eliminating your taxes. So taxes and the impact that you can have on them are one of the biggest reasons that I love investing in syndications. But on the flip side, one of the biggest reasons that the stock market gives you false hope. We've talked a lot about how the stock market is a mess, but really today we're going to cover four things. I don't know if we'll get to them all today. We might break this up into two. We'll see how long it goes. We try to keep them to 15 to 20 minutes, but the four things we'll cover. There's zero tax advantages from investing in the stock market. Investing in 401ks and mutual funds generally gives you false hope for your retirement and your post-W2 world. Investing in real assets are the path to living tax-free, and investing in syndicated deals are a passive way to living tax-free. So let's break each one of those down. There are zero tax advantages inherent to investing in the stock market. When you invest in a stock, it doesn't matter if it's an index fund, if it's a mutual fund, it's all comprised of a bunch of stocks. Those stocks are pieces of paper. They're not tangible assets. Depreciation is the key to eliminating your taxes, and you cannot depreciate a stock. You hear people talk a lot about tax loss harvesting, and they'll talk about that as a way that investing in stocks can be beneficial from a tax standpoint. We won't get into all the details, but this is essentially where you sell a stock at a loss to offset the capital gains from a separate profitable asset sale. This is only a thing due to how often stocks are sold at a loss. You don't ever hear about ways to utilize the tax benefits of selling real estate at a loss, because that is an extremely rare scenario. So beyond that, investing in 401ks and IRAs gives you false hope. Investing in 401ks specifically, so an active 401k through your employer, can make sense only if there is a match, and generally only if they match 100% of whatever you put in. This is because, for round numbers, let's say you invest $20,000, your employer matches it $20,000. Let's say it never grows. You leave the company and you decide you want to pull all that money back out. You would, if you paid the penalty, pay the taxes, assume you're in the 32% tax bracket, you put in 20,000, they matched 20,000 after the taxes, after the penalty, you would be left with $21,200. So if you had never put that $20,000 in your 401k and you had just taken it as income, it would be worth, after the 32,000, or sorry, the 32% tax bracket, it would be $12,600. So that is better, but there are still issues with this. While it's in your company's active 401k, the only option you have is to invest it in the stock market, and you can certainly, you are putting it at risk. You are extremely susceptible to losing a decent chunk of that. Investing money into your company's 401k without a match is crazy. It should never, ever, ever be done. This is simply false hope. It makes you feel like you're avoiding taxes and investing in your retirement when all you are doing is eroding money. Take that money out and invest it in a tax-advantaged thing like real estate and avoid taxes that way. Don't trap your money into this thing that you can't touch till you're 60. And that's the other problem. If you ever want a return on this money after your employees match, if you're considering putting in more, or if your employer just does not have a match, you are going to have to create a substantial return in the stock market, and you can't touch it until you're 60. That's a mess. I'll never understand, other than people don't know another way. I'll never understand how people advocate for this. Let's shift it from 401ks, because those are generally the worst, other than the potential of a match. Let's shift to just IRAs, so individual retirement accounts. This is just partnering with the government in a game where they make the rules and they can change the rules whenever they want. I want no part of this game. In traditional IRAs, so not Roth IRAs, but what are called traditional IRAs, you are foregoing taxes today to pay taxes later, and you have no idea what that tax rate will be. Maybe you'll be in a lower tax bracket at that point. The idea that the tax brackets are going to change to your favor is almost zero. Maybe you'll be making less money in retirement than you're making today, but I don't want to hope for that scenario. In Roth IRAs, you're paying taxes now to avoid taxes on the growth. Well, you can do that all day in real estate and create cash flow. That's the other problem with all these options: 401ks, with or without a match, IRAs, whatever the scenario is. You are not creating cash flow. You are not creating additional streams of income. You are shoving money away into the future in a game where you're partnering with the government. You don't know what the rules are going to be when you take it out, and you're hoping that it's going to grow over time, invested in this thing that you don't understand. And that is crazy. None of the 401k IRA options create cash flow. And that's a big enough reason alone to avoid them on the whole. I'll get off my soapbox, but man, that's crazy. Investing in real assets creates a path to living cash free. That's the third thing we wanted to cover today. So you need to become familiar with a few things, but you don't need to completely understand these things. You don't need to know. I'm going to go through them, but no, you don't need to know how to do these things. We'll cover that in the fourth thing, which is why we love syndications, but you need to become familiar with what these things are, because it can direct your investments. We'll go through all four, and then we'll dive into each one. Depreciation, bonus depreciation, 1031 exchanges, and refinances. So depreciation, investing in real assets. By real assets, I mean tangible things. You can go touch them, like houses, apartments, self-storage facilities, equipment that generates cash flow. Anything that you can go touch allows you to take advantage of depreciation. Pretty much every tangible asset has a depreciation schedule provided by the IRS. A depreciation schedule is simply a schedule that tells you how many years it's going to take until that asset is worth $0 on paper, not in reality. All this is just a paper game. So let's say you buy something for $100,000, and on the depreciation schedule, it says 5-year straight line depreciation. What that means is it's going to depreciate linearly or in equal amounts every year for 5 years. So if it's a $100,000 asset, it's going to go down in value on paper by $20,000 every year. If that asset is used in your business, you can deduct that $20,000 from any income you make and avoid paying taxes on that amount. If you just understand that, that is the biggest key to mitigating and eventually eliminating your taxes. Now let's talk about bonus depreciation. This is just depreciation on steroids. So if you have this asset, you have the depreciation schedule, you can do what's called a cost segregation study. Keep in mind, you don't need to know how to do this. You just need to understand what it is so you can speak intelligently about it. So if you do the cost segregation study, what it allows you to do is take advantage of bonus depreciation. What a cost segregation study is an engineer will come in and examine each element of the property and accelerate its depreciation deductions for all the different components within the asset. Like in a small apartment, the flooring, the windows, the fencing, the sidewalks. All of those have different depreciation schedules than the building on the whole. And so the cost segregation study alone will accelerate the depreciation schedule. For example, the flooring is going to depreciate faster than the exterior of the building. So now you have this cost segregation study. Now you're qualified to go take advantage of bonus depreciation, which currently in 2023, you can accelerate all of that. 80% of that whole thing you can accelerate into year one. So this is huge. This means that if you invest $100,000 in an asset, you can potentially write off $80,000 of it in year one. So for example, $100,000 asset, you have $80,000 in bonus depreciation because you did the cost segregation study. You're going to take advantage of bonus depreciation. If you're in the 32% tax bracket and you have $80,000 of other passive income from other deals, you would normally pay $26,000 in taxes. Investing in this $100,000 asset will take that to zero. That's the key. It's worth going back and listening to that a couple of times because that is the key to passively living tax free. It's actually active if you do it yourself, but you guys know how to do it passively. Let's move on to 1031 exchange. So a lot of people know something about 1031 exchanges, and really that's all you need to know if you're going to do the syndication thing. So a 1031 exchange is also called a like-kind exchange. So if you sell an asset and buy another asset that is like the first asset, for example, you sell one house, buy another house, that's a like-kind exchange. It doesn't have to be exactly the same. You can sell a duplex, buy two triplexes. You can sell a quadplex and buy a small apartment. They just have to be similar to each other, and there are rules that are specific to these things. The key, though, is that when you do that, if you do it the right way, you don't pay taxes on the gains from the initial sale because the government wants you to reinvest that money into more real estate. So there are tons of rules around 1031 exchanges. But the main thing to remember if you're going to do this on your own is do not touch the money. When you sell that first asset, you have to give the money to a third party. You never, ever, ever touch it. If you touch it, it's dead. You have to pay taxes on it. So when you sell the property, the money is held by a third party in an escrow account, and then it is used eventually to buy the new property. You can do this forever and keep increasing your cash flow and get bigger and bigger properties and never pay taxes. Eventually, you die, and so the taxes die with you. And now your heirs have a step up in basis. And what that means is you started here with one investment that was $100,000, and over 30 years, it's the whole thing. You've sold and bought and sold and bought, and now the whole thing's worth $10 million. Now, from a tax standpoint, they start at $10 million, and they can keep doing the same thing. That's 1031 exchanges or like kind exchanges. Let's talk about refinances. So the refinance is like the holy grail from tax-free cash. So as tenants pay down the loan on a property over time, you build equity. You also build equity by improving a property and increasing the rent, specifically on a multi-family property. We've talked about how those are valued on net operating income, not on comps like houses. Over time, the value of that property can be significantly higher than what you owe on the loan. At this point, you can refinance the loan, which allows you to increase the amount of the loan and pull out some of that equity in cash. Here's the key. When you pull that money out in cash, it is all tax-free because that is your equity that you created. It cannot be taxed. It is just a loan. But the beauty of it is you don't have to pay that loan. The asset is going to pay that loan just like it did the first time around. So with all of that, if you can take all of that, now you have a basic understanding of those terms. Now, all you need to know is that investing in syndications is a passive way to do all of that tax-free. The magic of syndicated deals is that all of that stuff, all the tips, all the tricks, if you can find a great sponsor, they'll do all of that for you. All you have to do is find a great sponsor and invest with them. When you find the great ones, latch onto them. When you learn this stuff, you can become very, very dangerous. You can become very, very valuable. When all you know is fully taxed, diversified index funds, why would you expect to create a significant amount of wealth? You're bringing nothing to the table. Anyone on the planet can invest in widely diversified index funds. But when you spend a little bit of time and learn a handful of things, you can change your whole financial life. If you find this podcast valuable, we would love if you would share it with anyone that you know. If you could share a link to it, if you could tell somebody about it, we just want to provide this kind of information to as many people as we possibly can. You can go to arete.investing.com, ARETE investing.com, and get our free guide to syndicated deals, syndicated real estate deals. It will give you a wealth of information. It's completely free. Go download it and don't skip leg day.